So hello everybody, and thank you for joining me for today's webinar, Entry-Level Investing for People Who Are Ready to Get Started and Want Some Support to Get Going. I'm Debbie Sasson, financial planner and money coach. I've been a financial professional for more than 30 years. I started my career on Wall Street as a financial analyst at Goldman Sachs, and I basically grew up on a trading floor, the place where all the action happens. I worked in New York and London until I moved to Israel 29 years ago and started working at our central bank, investing in the country's foreign currency reserves. And even though I was right in the thick of things and I understood the financial lingo and I had access to high caliber professionals, I still made some big investing mistakes, including losing about $50,000 on a really dumb investment that I made because I followed a hot tip. And I say that openly to let you know that whatever you've done or haven't done with your money, whatever mistakes you've made, it's okay. There's no shame, because if anybody should have known better, I should have known better, but I was young and naive, and I guess I didn't. And really, that's how we get smart with our money, by messing up and learning and doing it better the second time and the third time and the fourth time around. Now, 9 years ago, after the birth of my 8th child, and yeah, for those who don't know me, I'm the mom of a large family. I was burnt out, and I needed to slow down, which you can expect probably by the size of my family. Anyway, so I left the central bank and I transitioned into personal financial planning and money coaching. And today, I help people take charge of their money, make better financial decisions, and grow their wealth. I'd like to take a moment now to recognize everybody who's here on the webinar, because I've read a lot of posts this week on social media from people who are scared to invest. They feel clueless, they find the financial lingo confusing, and they hate dealing with their brokers. So if you're here in the room with us, and also for those of you who couldn't make it live but you're listening in on the recording, I really salute your courage and your desire and your enthusiasm to take the next step, to start investing and take control of your financial future. Now, a few things before we start. First of all, if you have any questions during the webinar, feel free to pop them into the chat box. If I can answer them quickly, I will. Otherwise, I'll circle back and try to answer all the questions at the end of the webinar. Second, a couple of people have asked me if I'll be talking about real estate investing or investing in property, and the short answer is no, because property investments, they can be a part of a diversified investment portfolio, but today's webinar is all about entry-level investing. And when you're investing in property, it usually means that you need to make a large investment and you might need to be borrowing money or taking on some debt in order to do that. So I'm not going to be talking about that. And finally, if what you learn here today makes sense and you're ready to take the next step to becoming a confident, empowered investor, then at the end of the webinar, I will be sharing with you a new course that I've created to help you take charge of your investments and your financial future. So let's dive in. Now I'm going to start the webinar by getting a little bit technical and geeky with numbers. I hope that you can deal with that. So here we are. We're going to start with the graph of the US stock market over the last 117 years. And this is a very long-term view, because many people, if not most people, have probably heard that if you invest for the long term and if you stay in the markets always go up. There might be extended periods of time when the markets are down, but if you hang in there and stay the course, then certainly from over 100 years of history, we can see, if we look from the bottom left of the graph all the way to the top right of the graph, we can definitely see that the stock market always goes up. Now here on the left side in the lower part of the graph, we can see the stock market crash of 1929, and that was a really huge change in the financial fortunes of many people, as certainly I as an American learned about that. And then if we follow the graph upwards to the right, we can see all the volatility, all the ups and the downs and the downs and the ups that happened over the course of time. And over here on the right side of the graph, we see that great financial crisis of 2008. And on a comparison basis, it really is minor compared to what the investors witnessed back in 1929. But even still, for those people who were invested and were relying on that money and those investments to carry them through, it was a huge financial blow. But again, if we stay the course and we stay with our investments, we can see that the financial markets did recover and they continued going up to where they are today, and we are at historical highs from the last 117 years, and certainly before that. Let me just have a drink of water. Okay, let's look at some numbers a little bit in detail. I think this is something else that people know, or they've heard, or they've intuitively know, and that is the importance of getting started early with our investments. So I bring this little example, I call it my Jack and Jill example. And Jack is a bright spark. He learned from a very young age that he should start investing, and he read books, he read the Financial Times, he spoke with his dad and other people, whatever it was. And from the age of 20, Jack made a commitment. He said, I'm going to invest $2,000 a year every year from today until my retirement at the age of 65. And I'm making the assumption here that Jack's investment portfolio returned an average 8% annual return. And at the end of 45 years, Jack's $2,000 a year returned $773,000, which is mind-boggling when you consider his investment was all of $90,000, and it multiplied exponentially in order to get him to $773,000 at retirement. And that's what we call, in investment terms, the magic of compound interest. It means your investment earns interest, and you earn interest on your interest, and it compounds and compounds and compounds exponentially, allowing your wealth to grow over time. Now let's look at Jack's buddy Jill. Jill wasn't able to get started so early, and she waited till 25. Not so old from many people's standards, but in this example you'll see that it makes a huge difference. And Jill at the age of 25 said, you know what, I also want to invest $2,000 a year, and she made a commitment that she was going to invest for the next 40 years of her life. Again, at an 8% return, and Jill ends up with $518,000 at her retirement. She made a total of $80,000 investment in the financial markets, right? Only $10,000 less than Jack. But at retirement, she ended up with $254,000 less money on $10,000 of investing. And that's the power of time, when we can stay in the financial markets and stay the course and let our investments grow and grow and grow. There is exponential power to our investing. So hopefully many people, know that already, or they've heard it, or they've heard about it, or could be that you're even meeting it for the first time. But if it seems so obvious that people should be jumping in and making changes to their regular financial habits, what is it that keeps people back? What stops them from investing in the markets, getting going from a young age? So in my experience as a financial planner, I've noticed that there are really 3 pillars to establishing confident and empowered investment. And I call those your money mindset, your money habits, and your money education. And when I first transitioned into financial planning, I really thought that it was all about financial education. I thought, okay, all you have to do is read the information and see the numbers before you. And I'm such a numbers geek, and it should be really simple. Hi from Yavniel, great, thanks for everybody showing up. All right, let me just turn off the chat box. Okay, anyway, so as I said, I really thought that it was all about financial education, and if people were just a little bit more educated, they would feel confident jumping in and investing. So let's look at what I find are some of the even more powerful reasons why people aren't jumping in and investing their money. Okay. People have mindset blocks when it comes to investments. It's scary, it's risky, they don't understand the financial language, they think it's not their zone of genius. A lot of people say that the financial system is corrupt and they don't have time. So let's explore these a little bit. Number one, it's scary and it's risky. So back at the beginning of the webinar, right, we looked at that very, very long-term graph, and we can see that if we stay the course and we don't panic when the market gets into a crash or a crisis, or the financial markets tumble down, and we can hang in there, then over time, again, I don't have a crystal ball. I'm not a prophet. I can't guarantee you that the next time the market tumbles, it's going to be all, sweets and chocolates and roses, and things are going to turn around quickly. But 100 years of history is a pretty convincing argument to me. And if we can just tune into, within our psyche and within our body, those panicky feelings that are sort of triggering us to want to get out of the markets at the wrong time, then hopefully, and there's an awareness of what's going on, then I'm not suggesting that it will be easy to necessarily stay in the markets, because it's never easy for you to watch your money go down and to lose value. If you think today that you have $1,000 and you wake up tomorrow and you look at your investment account and it's only worth $500, that's not an easy thing to swallow. But if there is an awareness of how we're reacting, in our minds and in our bodies, then we can hopefully turn down the volume on all the smoke and mirrors that's going on the outside, and we can, work harder on eliminating that sort of money block and mindset that we have to panic and run for the hills when things start to get a little bit rocky. Now, what about financial lingo, which is confusing? And yeah, I agree, financial lingo is confusing, but that's simply because it's a new language. And anytime we're learning something new, we're faced with a new language. I mean, if you're coding on a computer and you have to learn HTML, that's a new language. And in this day and age where we're all, forced, more or less to become, techie or, geeky that way, people do have the ability to adapt and learn financial language, or certainly other foreign languages, let's say. And from my own personal experience, when my husband was sick, 14 years ago, he was diagnosed with cancer. Thank God he's okay today, and that's actually a whole part of our money awakening, because that forced us to get to really sort out our finances. But leaving that aside, we also had to learn a whole new language. I had to learn what the difference was between seminoma and non-seminoma cancerous growths. And I don't really even remember so much what it is today, because thank God it's not part of my day-to-day living. But when we are forced to learn something, or when we're excited about learning something, that also melts that resistance, and we do have the ability and capability to learn a new language, which can also be a financial language. Okay. Number 3, it's not my zone of genius. A lot of times with women in particular, we have this money block, and we think that investing is all about math. And if I wasn't a math whiz in school, and I don't understand all that techie stuff or that sciencey stuff or whatever it is, I, as a woman, I'm not going to be good with numbers, and I'm not going to be good with investing. But, I think to a large extent, as women, thinking that it's not our zone of genius, I think it really comes from a really long and extended history of women just not being in charge of the investing. It was only in the 1950s, 1960s with the feminist movement that a whole world opened up to women, where they went out and they started becoming active participants in the income of their families. In the United States, it wasn't until the early to mid 70s that a woman could even own a credit card with her name on it. So we had a very long period of conditioning where we weren't in charge of investing, and most of us don't have role models. We didn't see our mothers sitting down and getting all geeky about finances, investing, and so we don't really know where to go or where to turn in terms of getting those skills. So I don't want to say it. I want to say that women do have the ability to make investing their zone of genius. And in fact, if we look at the research, when women do get involved in investing, they actually do a better job at it than men. That's what the research shows. All right, number 4, the financial system is corrupt. You know, there have been many books and movies written about the corruption on Wall Street. And if you remember in the 2008 financial crisis, you know, the Ponzi scheme, Bernie Madoff, and people lost all, you know, did lose their fortune. Yeah, it happens. And the more we take ownership of our money and our investments and our financial future, the less likely we are to let something like that happen. You know, there were definitely signs with a Bernie Madoff type of, you know, investment scheme that there was something fishy going on, but people let themselves be misled. Again, they weren't leaders of their money, and you know, the fact of the matter is that is the financial system that we have to deal with. So we really need to look at it and feel comfortable with the stock market and the bond market, and that might be a market that you know are not yet familiar with, but there definitely is a reason to look and see how we can be the captains of our own ship and the leader of our financial future, so that we don't necessarily have to leave it to somebody else who may be unscrupulous. And number 5, and I've heard this a lot also, people say that they don't have time, that it takes too long to get involved in their finances and their money management. And really, anytime there's something that we really desire to do and it's really important to us, somehow we figure out how to squeeze it into our day. And when it comes to money and money management, it's really, really important that we take charge of our financial future. Okay, so let's move on now into the second pillar of successful investing, and that is developing strong money habits, and that which enable us to invest. And these are, you know, you might say, well, investing, what does this have to do with my day-to-day money management and money habits? But really, it has everything to do with your day-to-day money management and money habits. Because if your spending is haphazard and you never know where the money's going, you know, you're not able to set money aside on a regular, consistent basis, like our friends Jack and Jill, to invest in the financial markets. And so it's really important to, again, plan your spending out on a monthly basis so that some portion of your income is being set aside for investing and for growing your wealth for the future. And these are really common stepping stones along the way to developing strong financial habits, is making sure that you differentiate between your needs and your wants. Because if you're taking care of all of your wants today, then there's not going to be money in the future for you to take care of yourself. You know, you're really selling yourself down the stream by saying, oh, you know, today I'm going to get this bright new fancy shiny object, and I'm going to let future Debbie deal with her and with her situation and with her retirement because I just want this thing right now. So it's really important that we realize that our financial future is a real need. It might be hard to conceive of what we're going to be like in 20 years from now, or 30 years from now, or 40 years from now, but in our future we will have financial needs, and it's important that we bump that up higher up on our priority list. And we do that by paying ourselves first. And this is, again, a very known concept. Probably many of you have heard of it, especially if you're running your own business, is that we want to, you know, again, there's a profit first model, and it's the same thing when it comes to personal investments, with your personal financial planning, is when you have some income, take the cream off of the top and set that aside so that you are investing in yourself for the future. Okay. Number 4 is to make sure that you have some safety net savings, because life always happens. You know, you might get a flat tire that was unexpected. You might need some plumbing work that was unexpected, or some, you know, something that happens that you just couldn't plan for. And if you don't have some money set aside in a safety net account, so you're going to have to turn to your investments, and you might end up having to sell something exactly when the financial markets are down. You know, if you can remember back to that graph that I showed you at the very, very beginning, you know, if you sell one of your investments when the financial markets are at a loss, you've basically locked in your loss. But if you can hold out and you can carry through for another 2, 3, 4, 5, 20 years and ride the wave up again, you'll be able to realize a financial gain on your investments. So it's really critically important that you have some sort of safety net sitting on the side there for when the unexpected happens. And in addition to safety net, I always encourage my clients to have a financial freedom account, which is, also for things that are exciting, unusual, unexpected. You all of a sudden you get a low price ticket to go off to Europe for the weekend, or you want to go and join a family celebration that's on the other side of the world, or you want to go to a conference that's on the other side of the world. Whatever it is, if you have these like pots of money stashed away, then you won't feel like your investments are inhibiting the quality of your life today and tomorrow and sort of in the near term. Now the fourth, is that the fourth point? I think it's already on. It's maybe almost the sixth point, right? Is under earning. And this is a real problem, and it's particularly a problem with women, more so than men. We know for sure that there's a wage gap, and that wage gap between men and women for the same jobs still exists that women earn, whether it's 69 cents on the dollar or 77 cents on the dollar. For the same employment, women will definitely receive less than men. But what happens is that women don't negotiate their salaries. They don't take the opportunity, and I'm speaking in broad generalizations, to move from job to job. And very often, if you've been in one particular job for 2 years, one of the best ways to increase your salary is to move to another job. And this is something that men do routinely in order to increase their earning power. And women need to take stock of that and pay attention to how much money they're bringing in, because we can decrease our expenses to a certain minimal level, but we all need to eat, and we need a roof over our heads, and you might need some new clothing from time to time, but earning is really, the upside is unlimited. And if you're finding that your monthly spending doesn't have a lot of wiggle room in it for you to put money aside for savings and for investings, then I encourage you to look at what's going on with your earning and how can you increase your earning power. If you're in business for yourself, check when was the last time you raised your prices. Maybe the first thing that you can do to increase your, and support your financial future is to increase your prices. And then rather than all of that extra juice going to today's spending, you can put that aside for your future. And what I really encourage you to do, which is the last bullet point, is become an active participant in your money management. Don't just let things happen to you, because if you don't take care of your money will, your money is going to take care of you, but not exactly in the way you want it. Interestingly, one of the common goals that I hear from my financial planning clients, when I'm taking in a new client and we're doing an intake fill and clarifying their financial goals, one of the main financial goals that I hear over and over again is that parents don't want to become a financial burden to their children. And what better way to ensure that you don't become a financial burden, which is by investing in your future. So if you have a choice today between, giving something extra to one of your kids or taking that, even if it's $20 and investing it for your future, just think about what a wonderful gift you're giving your child by investing in your future, because it means that they're not going to have to take care of you when you get old and gray. Okay, so I encourage you to think about, what's standing in your way. What's preventing you from creating financial change? Is it that you feel nervous about raising your prices or jumping and moving to a new job? Is there something that's going on in your day-to-day spending or financial management that you don't want to give up? What is there that's blocking you? And I really strongly encourage you to make a commitment to just look at each sort of line item in your monthly spending plan and make a commitment for just one change, something that you can do differently that will help you to grow, confident wealth for the future. And this is one of my favorite sayings, and that is taking care of your money is exquisite self-care. Women in particular are great at taking care of themselves, whether it's with a massage or a manicure or getting your hair dyed or whatever it is. We know how to take care of ourselves. But we have to also adopt the mindset that taking care of our money is self-care in the biggest, beautiful way, because a manicure isn't going to last us till we're 100 years old, but making sure that we have a beautiful financial nest egg, that's what's going to take care of us long into the future. Okay, pillar number 3, and that's money education. And as I said, when I first transitioned into personal financial planning, I thought, heck, money education, that's all we need, and everything is going to be simple and everything is going to be hunky-dory, and we just have to read a few books, take a few courses, and people are going to understand what they need to do to grow their wealth. So first of all, there are financial instruments that people are unfamiliar with. There are stocks, bonds, mutual funds, ETFs. Let me take a few moments to just help you understand these financial terms if you've never heard about them before. And stocks, for example, stocks are an ownership interest that you have in a company. So, for example, let's say that you own stocks or shares, in different places of the world, they're called different things, in Coca-Cola, right? If you own stock in Coca-Cola, it means that you are a partial owner in Coca-Cola. If Coca-Cola is profitable, then you as an owner, you get to enjoy the profits of the company. And usually a company is profitable when the global economy is expanding, and that's when we see that stock prices are going up and things are looking very, very rosy. Again, when there's a financial market collapse like there was in 2008, the prices go down, and the owners of the company, they are definitely the ones who let's say, suffer because the value of their ownership interest in the company declines. Okay? Now, bonds are something that many, many people haven't even heard of, but when I said that I grew up on a trading floor, I actually grew up on a bond trading floor. I actually came to know and understand and love stocks much later. When a company like Coca-Cola wants to, let's say, open a new bottling plant in China, it's expensive to open up a new plant, and they have a few different courses of action. And one of those is to go to their bank and borrow some money from their bank. And the other way that they can borrow money is they can go out to investors like you and like me, right? You have some money, maybe even, those of you who are on the call today, you've amassed a little savings cushion or nest egg in your bank account, and you want to get going with investing with that. Well, one thing you could choose to do is to lend to Coca-Cola or to IBM or Apple Computers or other companies. You can lend them money, and they will pay you an interest rate on the money that you lend them, and that's what we call a bond, right? So bond is basically a synonym for you loaning money to, it could be a governments issue bonds, or it could be to a corporation, a company, to a municipality, to an agency. There are all sorts of different types of institutions that issue bonds, and that basically means that that entity is taking a loan. Number 3 are mutual funds, and in the ETFs, which is next to it, that is short for exchange traded funds. And mutual funds and ETFs are very, very simple for our intents and purposes. They're really synonymous. A fund is a collection of different investments. So there could be mutual funds or ETFs that hold only stocks. There could be mutual funds or ETFs, funds as it were, that hold only bonds. There can be mutual funds that are a combination of stocks and bonds. There are many different investments that you can put inside a mutual fund. the way I like to describe it, which I think is very good, and we can understand it, is that if you go to the supermarket and you want to buy some vegetables to make a salad, right? You can buy your lettuce, and you can buy your cucumber, and you can buy your tomatoes and your peppers and your mushrooms and your onions and everything. You can buy individual pieces of each one of those types of vegetables. Or nowadays, we can go into the supermarket and we can buy one of those plastic containers that has the salad already prepared and already, waiting for us inside. And a mutual fund is kind of like that salad that's pre-prepared in a plastic container. I mean, it's not disposable, but basically somebody else has done all the work and they've created an investment for you that you just take as it is, and you can put that into your investment portfolio. And you don't need to do all of the research that's involved in choosing stocks, because it's time consuming to decide, do you want to invest in Coca-Cola or Pepsi? Do you want to invest in Microsoft or IBM or Apple? It takes time and energy, and it really takes away from what we want to do and what we want to accomplish on a day-to-day basis if we're forced almost to spend the time researching different stocks and different companies and understanding which one is going to be the next best Apple computer or Facebook, so that we can make our financial fortunes. So those are the basics of the financial instruments that people need to understand when they get going with investments. And then, when you want to invest, you have to figure out how are you going to invest, where you're going to invest, who's going to be, we call it the custodian of our money, right? Where am I going to put that? So there are a few ways that you can do it. If you have a smaller amount, like, I'm just going to skip down to the third bullet point, and I'm going to talk a little bit about micro investing first. And this is something that unfortunately does not yet exist in Israel, where I live, at least not that I've become familiar with, but certainly in the United States and in England, in Canada, in Australia, micro investing is a thing. And there are apps which enable people to start investing with as little as $5. You can start investing in mutual funds, again, that hold stocks and bonds. And just to give you a few names, and then you can go and do the research and see what's available in your country. But there are apps in the United States. There's Acorns, Stash, Robinhood. Acorns is also available in Australia. In the UK, there's an app for micro investing called Moneybox, and in Canada, there's a different app called Milo. There are many ways for people who live in larger developed countries, not like Israel, which is a tiny little country, but countries that really have economies of scale, and they've developed these possibilities and for investing, where you can really get started with a teensy little amount of your money. And you know what? It actually makes the risk a lot smaller, because if something happens and you just started investing $10 or $20 and the markets go down by 50%, okay, so you lost $5 or $10, and it doesn't feel so painful if that's what's going on. For those of us that don't have that option, so then there are discount brokerage houses, and again, each country might be calling it something else, but these are basically platforms in an investment house or brokerage house where you can go and you can construct your investment portfolio by yourself using these mutual funds that are pre-prepared for you. And again, in the United States, the top 3 discount brokerage houses that people use are Fidelity, Schwab, Vanguard, or fourth is TD Ameritrade. And in different countries, you basically will have to go and do some research and figure out what's available in your country. In Israel, we do have some platforms available, but they're not nearly as inexpensive. Again, because we're a small country, they're not nearly as inexpensive as people can access in other larger countries of the world. Catherine is asking, is one free to invest anywhere in the world? Can I do the micro investing in the UK, though I'm based in West Africa? There are capital controls where you can't easily shift your money from one country to the next. You'd have to see in the UK what they do and don't allow. Now, sometimes on the Irish exchange or the Luxembourg exchange, people who live outside of the UK are able to invest. But it would definitely, Catherine, be an area where you need to do a little bit of research and see what you can do. I know that in the United States, they're very, very cautious and careful, and they want to make sure that only U.S. citizens are investing in these micro investing possibilities. So again, if you're not living in one of these major developed countries, it might be a little bit more challenging, but don't give up. Do some research and see what is available to you, because even if it costs you a little bit more and it's a challenge and it's a hurdle and something that needs to be overcome, it's certainly better to incur those extra fees that we have to incur by virtue of not living in the United States or Canada, the UK, or wherever. But again, in the long term, it's going to be worth it, because we're going to have that financial cushion supporting us. So Hannah's asking, is it true as an expat investing in the United States? I think we kind of lost the train exactly of where your question fits in, but as a U.S. citizen, you should be able to open up an account in the United States. It might mean that you need to use somebody else's U.S. address, whether it's a parent, a sister, a friend, or something like that. So, and all these things, you fill out the paperwork online, quote unquote, the paperwork, it's all virtual these days. But you fill out that virtual paperwork online, and so as long as there is a valid address and a zip code, and you have a valid social security number, and even these days you can trick your computer so that it doesn't realize that your URL is coming from Israel, and it shouldn't be a problem for you to sign up to one of these, micro investing platforms or even a discount brokerage in the United States. So, basically what each person needs to do is, again, take charge and become the leader of her money and figure out what are the possibilities for you in your country, or again, how to get in through the back door so that you can start investing in financial assets and growing your wealth. And the last point that I want to make in our little mini money education part of today's webinar is that there is a very big difference between what we call passive investing and active investing. And these are, again, financial terms that are very, very commonplace in the market. Let's go back to that first slide that I showed you. And if you weren't on the webinar yet, I'm sorry, you'll have to check it out in the recording. But I showed you 117 years of history in the U.S. markets, and it was basically an index that we call the Dow Jones Industrial Average. It's a collection, a conglomerate of all of the large industrial companies in the United States. So what is passive investing? Passive investing says that this particular mutual fund or ETF, exchange traded fund, is going to mimic, to be a copycat of a certain market index, so that when you invest passively, you're not making decisions, or the investment manager of this mutual fund isn't making decisions, like I said, or do I invest today in IBM, or do I invest in Apple, Microsoft, or Dell? The index holds the entire market. So basically your return on your investments is the entire market. You own a teeny tiny little piece of every single company that's in your index. You don't own the index, you own, again, a copycat of that market index. And many people have probably heard the S&P 500 Standard & Poor's 500, the 500 largest companies that are traded on the exchange in the United States. And in England, you have the FTSE. In Germany, you have the DAX. You know, there are many different indices throughout the financial world. Japan is the Nikkei. So, you know, if you want to just get the market, you know, just get the return of the market, which in reality, most people who are actively trading in and out and in and out and in and out of the markets and trying to decide, oh, the market's going to go up today, the market's going to go down today, oh, I think I better buy, I think I better sell. What happens when people are actively trading and trying to time the market is most of them do worse than the market itself. So if you would feel comfortable and confident doing better than 80% of those active investors out there, and if you would feel satisfied with getting the return or similar return to the market itself, then one easy and strong way for you to go forward with your investing is to do it by investing passively. You know, invest in a mutual fund that follows the market, and then you're good to go, and you don't have to overthink your investments. And that really makes it easy, and it's not too time consuming. There is just a very limited amount of, you know, financial education that you need in order to feel comfortable and confident investing in the stock market. But again, if we go back to the beginning and we sort of sum it all up and everything we've talked about, right? It's not just knowing that financial education, that, well, if you have that passive investment, then you are going to get the market return for your investing career, let's say, because, you know, we've been enjoying now 9 years of, or 8.5 years of rises in the financial markets. But what's going to happen, you know, next time, whenever that comes, when the markets sell off, when there's a crisis, when there's a tumble, when there's a crash? And that's why you need to work on your money mindset and your money habits in addition to your money education, so that you will be able to take ownership of your money and you'll be able to grow your wealth and shape your financial future. So if that's something that speaks to you and you would like to become more involved in taking charge and becoming a leader for your money, I said at the beginning of the webinar, I've created a new course, and let me take this opportunity to tell you about it. I've created a course called the 1K Investor. It's for people, again, who want to start small and want to get themselves going, learning about investments, really taking little tiny baby steps to build up their money muscles. And in this course, you're going to get 3 pre-recorded training modules, and there are accompanying worksheets with easy actionable exercises. And we have a dedicated Facebook community, so anybody who has a question on what's going on in the videos and the trainings and don't understand something, you can come into the Facebook community, you can ask questions. I'm there to hold your hand, and I have my own long history of investing and the mistakes that I've made along the way, and I'm a pretty compassionate person when it comes to, you know, women and investing and getting themselves going. And through the program, you will become much more confident and feel much more empowered investing in the markets and growing your wealth. I guarantee you that you're going to develop stronger financial habits. You will understand financial jargon so that it won't make you feel so shaky and put you off to investing. And you'll have a plan to begin your investing journey. The introductory price for the course is $36 US. And that's going to be around for the next 10-11 days until September 10th. And it got cut off there. But if you would like to go and look at the course, then this is the URL that you can go to. It's debbiesasson.thinkific.com/courses/invest. So maybe what I can do is I can pop that into the chat box for anybody who is interested. Let me just do that. Oh, Jasmine did it for us. Thank you very much. And if you have any questions, you know, the line is open, and you should feel free to jump in and ask me questions. I think what I'm going to do now is I'm going to show my video, and I think I stopped sharing my screen. And anybody who's here on the call should feel free to come along and ask questions. So Emma's asking, to buy shares in index funds, can you go to your bank? Emma, you're going to have to find out what's available in your country. Certainly in Israel, we can do it through our bank, but I don't know in your country what is available and what you can and cannot do. You're going to have to do a little bit of research yourself. Okay. What about land investing? Land investing is a wonderful idea, and as I said in the beginning of the webinar, investing in real estate, investing in property, investing in land. So that's usually a bigger financial investment. Most people don't start investing with $1,000 or 1,000 euros or 1,000 shekels by investing in land. And sometimes, you know, if it's depending on how much you're interested in buying, you might have to take a loan for that. So that's not really the focus of our webinar today, but it's definitely a great way for you to, you know, grow your wealth for the future, as long as you make sure that you do your research. So Catherine's asking, is the Facebook group a regular meeting with you? The Facebook group exists now. It exists today. You can go into facebook.com/groups/Savvy Money Academy, and you are invited to join the Facebook group. Yael is asking, is there a book or pamphlet that you suggest for U.S. Israeli dual citizens to understand what are the rules with regards to taxation? Yael, I don't really think that it's that complicated to understand the differences. Basically, a U.S. Israeli dual citizen should not invest in mutual funds that are issued outside of the United States, because that qualifies as something called PFIC. Yeah, Catherine, I'll do that in a second. You know, you need to speak with your accountant, Yael, and ask your accountant whether an ETF is considered a PFIC for your reporting purposes to the United States. Different accountants have a different view on that. So again, you're going to have to check that one out with your accountant. Let me just put the URL into the chat box, facebook.com/groups/Savvy Money Academy. Okay, there you go. Oh, great. Jasmine got there before me. Okay, so anybody have any questions? Any further questions? Okay, so I thank everybody for joining me here today, and if you have any further questions, then you should, you know, feel free to get in touch with me, or you have the URL for the Savvy Money Academy. Emma's asking, will you send the sale link in an email? Yeah, I hope that you're going to get the recording in your email tomorrow, and you'll also have the sale link in that email. And Emma says they cannot click on your link in the chat box. Okay, maybe you just have to write it down on the side, or you know, you can just go into your Facebook search bar, and you can type there Savvy Money Academy, and it's the only one of its kind. So I think that would be pretty easy. Thank you, Ava, very much for showing up, and Atara and Yael. Thank you, everybody, for being here today. I really had a great time. Bye, Anne Marika. Thank you, too.